Everyone, why don't we get started? So I'm super excited to have joining us again, Paul and Lubna Chano, but Paul's going to be talking to us about the Big Beautiful Bill. So Paul is from Tax Planning Boutique, which is a tax strategy firm specializing in physicians and medical professionals. He's given us a lot of great webinars and content before, and so I asked him to sort of analyze what we need to be focusing on tax-wise based on the changes that are to come, regardless of where you stand in terms of what you think about it. We need to be educated about what the changes are and how we can best attack them to optimize our tax strategies. And so that is exactly what Paul is here to share. So I'll hand it on over to you, and we'll definitely have time for Q&A at the end. If you have questions during, though, I know just feel free to raise your hand virtually or otherwise and chime in, or if you want to leave them in the chat box, because we definitely want this to be interactive. So, Paul, thanks again for joining us.
Thanks, Jordan. Thanks for having us. Hi, everyone. My name is Paul Channo. I'm part of Tax Planning Boutique with Lubna Channo. I am an enrolled agent and a real estate tax strategist. I'm here to introduce the proposed new tax legislation for 2025. The GOP have released their first proposal of the Big Beautiful Bill for massive tax changes. On May 22nd, 2025, the House of Representatives passed the Big Beautiful Bill, a sweeping 1,038-page package that's now in the Senate's hands, and the text portion was about 400 pages. This bill touches nearly every corner of the tax code, and the best part is that some of the provisions take into effect in the beginning of 2025. If you're wondering what this means, the translation is tax planning is no longer a wait and see game, it's a now or never scenario. In this webinar, you'll walk away with a clear understanding of how to act, not react, under the 2025 Big Beautiful Bill. After discussing the proposed changes, we'll open for questions and we'll discuss maybe some planning opportunities as well, and we'll definitely be able for an open discussion. So as a disclaimer, everything here is proposed law. It's not been signed into law. The provisions contained in this presentation may change. This is not tax advice. This is simply educational to discuss the current state of the proposed tax laws, and will only stick to the relevant tax proposals in the bill. Now, the topics that we're going to hit today: depreciation, everyone's favorite, no tax on tips and overtime, the car loan interest deduction, the qualified business income deduction, the SALT limit, qualified opportunity zones, qualified production property, MAGA/Trump accounts, HSAs, R&D expensing, and 1099-K reporting. And then for the negatives of the bill, the pass-through entity tax, solar and electric activities, excess business loss limitation, and mortgage interest deduction limitations. So to start with the tax brackets, under the current law, the lower tax rates are set to expire after December 31st, 2025. And what this proposal does is it will continue the TCJA tax brackets permanently. So if you're seeing on your screen in the middle column under current law, if this bill does not get passed, the TCJA sunsets after December 31st of this year, and we go back to larger tax brackets. Everything shifts back up. But what this bill does, this permanently extends these tax brackets. So there's no more 8 years and then another extension. Most of these provisions will be permanent. I will let you know which ones will not be, but there are definitely some permanent extensions for the good and for the bad. Now, some benefits that I see in this bill is the qualified business income deduction. So current law is 20%, and what this bill does, it increases this to 23%. This is for partnerships, S corporations, sole proprietorships, but the deduction is taken at the individual level, and especially some real estate investment trust dividends, publicly traded partnership income. Without this bill, this expires after this year, and we lose the deduction entirely. This provision makes the deduction permanent, increases it to 23%, But there is also a limitation that has been here currently with the current law, but it will be permanent. Now, the provision for the limitation is what we call specified service trader businesses, which is basically any trader business involving health, law, engineering, accounting, consulting, finance. Basically, if the business is the reputation or the skill of one or more employees. Now, if you're married filing jointly, and you make over about $400,000, then this deduction will start to phase out. It's not a light switch where you just lose the deduction entirely. Uh, every dollar you make, they take away a certain percentage of this deduction. So it's not entirely at 400,000, but once you get over that mark, that's when you start losing this deduction. And the 23% increase is actually going to take into effect in 2026. So we will see this 20% deduction at this level for the rest of the year, and then we'll have a bump up next year. Now, for any estate planners out there, the bill proposes to increase the exemption to by an extra 1 million to 15 million per each individual. And what this does is make this permanent as well. Currently, this is going to be set back after this year if this bill does not pass to 7 million, essentially half of this amount. Right now, with the TCJA, we do have a $14 million exemption. And if you're married filing jointly, that's combined with your spouse. So with this bill, you could get approximately $30 million of estate and gift exemption. So basically, what this does is if an individual passes away with an estate value of 13 million, he would be exempted from estate tax. Now, if it was 16 million, he would have to pay 1 million in estate tax if he was not married filing jointly. But so this is great for the estate planners out there. Now, for the child tax credit, we see an increase from 2,000 to 2,500 per child. Now, what's going to be permanent is the $2,000 per child because before the TCJA, it was $1,000. So we will see the $2,000 permanent, and the bump up to 2,500 will be increased through 2028. And then, of course, with our standard deduction for those who do not have enough expenses to itemize, we are going to see a bump up across the board. So we will keep the bump up from the TCJA, which essentially doubled the old law. As you can see in the middle column for current law, this is what it would look like if this bill does not pass and the TCJA expires next year. But with this bill, not only will we keep the doubled portion, but also for married filing jointly, there will be an extra $2,000 head of household for 1,500 and singles for 1,000 extra. Now the bump up will stay 2028 and then it will phase out and sunset in 2029, but we will continue to see the doubled deduction permanently. Now for some negatives. We have what we call the mortgage interest deduction limitation, and this has been extended permanently. I see this as a common mistake on tax returns. What this rule does is it sets a cap on how much interest you can deduct on your primary residence. So if you purchased the property and the loan was acquired after December 15th, 2017, the amount of interest you can deduct on the primary residence will be up to the loan amount of $750,000. So even if you purchased the home before and then took the loan after this date, you still qualify for the $750,000 limit. Before this limit, we had a $1 million limit. So if you took the loan before this date, you will be subject to the $1 million limit. Now, another common mistake I see people make is they assume they can take a home equity loan against a rental property, use it for their primary home, and deduct the interest. In this case, the interest is not deductible. It has to be from a primary or secondary home, and the loan limit will be $100,000, and it must be used to purchase, build, or improve the primary residence. So you have the interest up to the $100,000 loan amount, and that's going to be permanent. Now, probably one of the worst provisions that I'm seeing in this bill is the excess business loss limitation, and this is going to impact us real estate investors as well. So what this provision does is it caps off the loss that you can take in an aggregate of all of your business income and loss. So basically, if you are a high income W-2 earning $1 million in wages with no business income, the maximum business loss you can take is $626,000 for 2025 if you're married filing jointly. So if you're planning to purchase real estate and take this big loss against your income, let's say you plan to take 800,000 in depreciation losses, you will still be capped at $626,000 if you have no other business income. Now, those deductions aren't lost, they get carried forward to the next year, but this is definitely something to watch out for. As if this bill does not get passed, this is set to phase out after 2028. Now, that means that there is no loss limitation, and even if you are this high income W-2 earner, you can potentially offset the whole amount if you have the allowable losses. But this is going to be permanent with the passing of this bill. Now, just to differentiate with the W-2 earner and the business owner, on the other hand, if the business owner is profiting $1 million in business income, then the maximum business loss is $1,626,000 for a married filing jointly person. Now, if you're not married filing jointly, this is going to be even lower by half to $313,000, which is a real pain because if you're planning to offset your losses, you have this obstacle to go around. And this is really where okay, you have to carry over these losses. Now, the tips and overtime provisions. So are tips really not taxed? Is overtime really not taxed? We'll get into it. The no tax on tips, overtime provisions, they are here, but not everyone will be able to claim them. Starting with no tax on tips, there's only a certain type of business that will be able to claim them. They are food and beverage services, serving or delivering, barber, hair care, nail care, aesthetics, body and spa. Now, we talked about specified service trader businesses and the qualified business income deduction. Unfortunately, these fields will not be applicable for the no tax on tips provisions as well. Just to remind you what those are, that's health, law, engineering, consulting, finance, and etc. So what this does is it allows qualified tips to not be taxed for those that are making less than $160,000, also known as the highly compensated employee. Now, what a qualified tip is the tip must be paid voluntarily. It cannot be subject to negotiation, and it's determined by the person giving the tip, not the person receiving the tip. So if you've ever read a restaurant bill, the bill comes in after you've had a very nice meal, and the bill says uh, gratuity included 20% already. That wouldn't even count because it has to be paid voluntarily. So any tip after that would be subject to no tax on tips. But is it really no tax? No. So this deduction would be an itemized deduction and it would be reported on the W-2, but it's also subject to the payroll tax. And that's something a lot of people forget about. There is a tip tax credit for a portion of the taxes that were paid from the tips, but you still have to pay the tax on the tip for Medicare and Social Security. And this deduction is not permanent, by the way. It sunsets after 2028 if this bill gets passed. Now, with overtime, this provision allows overtime compensation paid to an individual in excess of the regular rate at which such individual is employed. So what this basically means is if you're working more than 40 hours a week, and let's say you get time and a half or double time, the bump up after the 40 hours is not subject to federal income tax. It is subject to payroll tax, but it is not subject to income tax. So that doesn't mean that the whole hourly pay after the 40 hours is totally tax-free. I wish it was, but this is sort of a misconception. When we hear no tax on overtime, we think no no tax for a portion of it, but not for the whole thing. Now, same thing, no highly compensated employees allowed. So this is great for kids if, they're in college or they just finished college and they're making under $160,000. They can, put the work in, work the 50, 60-hour week, just like I'm sure what most of you doctors do, and hopefully get that benefit because this provision also sunsets at the end of 2028. It is similar to an itemized deduction as well, where it's below the line. It is going to be reported on W-2 and it is subject to payroll tax as well. And then another provision is you cannot take the no tax on tips and the no tax on overtime provisions at the same time, actually, along with the qualified business income deduction. So it's one of the three. Now, no tax on Social Security. Is this real? It is not included in the big and beautiful bill. However, for the time being, seniors will receive an extra $4,000 in deductions if they're age 65 plus and the income is under these thresholds. Now, there is a bill currently in the House floor called the Senior Citizens Tax Elimination Act. It is literally a two-page bill, and it calls for the complete elimination of tax on Social Security benefits effective beginning after the date of the enactment. So once Congress passes this bill, Senior Citizens Tax Elimination Act, not the big beautiful bill, then that's when there really is no tax on Social Security benefits. But that is not included in the big beautiful bill. It is separated out in a different bill. Now for the car loan interest deduction. The car loan interest deduction has a $10,000 interest deduction limit, and the initial loan acquisition must be after December 31st, 2024. Now, the phase out begins if the income exceeds $200,000, married filing jointly, $100,000 for everyone else. And there are some extra rules, as I'm sure you've heard. The total reason why they're allowing this deduction is because they're promoting more cars to be made in America due to the tariffs and things like that. So the rules and regulations on claiming this credit is the car must be manufactured primarily for use on public streets, roads, and highways. It has to have at least two wheels. It has to be a car, minivan, sports utility vehicle, pickup truck, or motorcycle, and the final assembly of which occurs in the United States. Now, there are a lot of types of loans and payments that are not applicable for this deduction. That's loan to finance fleet sales. If you have a fleet of cars that you're renting out, that would be more of a business deduction. Personal cash loans secured by a vehicle previously purchased by the taxpayer. Loan for purchase of a commercial vehicle that's not used for personal purposes, which that's again more of a business deduction. Leases are not subject to this. Loan to finance the purchase with salvage title, and loan to finance the purchase of a vehicle intended to be used for scrap or parts. So this is pretty much for a personal use vehicle. You have, the middle class and everyone else. If you're under the $200,000 income level, they get this $10,000 interest deduction, and everyone else is either phased out or they don't get this deduction. Now, with MAGA/Trump accounts, I did not name this. I'm simply just the messenger. But what this account is a money account for growth and advancement. It creates a new kind of savings account designed to incentivize education, entrepreneurship, and home ownership while promoting financial security. The MAGA Trump accounts must be funded, the funds must be invested in a diversified fund that tracks an established index of US equities. So starting in January 1st, 2026, parents may open a MAGA account or a Trump account for children born before January 1st, 2024, and they're eligible to receive contributions from parents, relatives, and other taxable entities as well as nonprofits. Now, the contribution, taxable entities may contribute up to $5,000 annually of after-tax dollars. The limit is indexed for inflation. And if it's coming from a charity or any other tax-exempt entity, they're not subject to this $5,000 limit. It must be if they want to have a charity invest in this child's MAGA or Trump account, it must be an unrelated third party. You can't just go and open a charity. And you have to actually provide this contribution for all the children within the group. And what do I mean by that is, let's say this charity decides to put $1,000 or maybe $10,000 into each child's um, MAGA account that's within a certain school. They have to do it for everyone. So they cannot just do it for one or maybe two people. They have to do it for the entire group, whatever that group is. And there's no contribution after the beneficiary turns 18 years old. Now, for the distributions from this account, once the child hits age 18, they can take up to 50% of the funds for qualified distributions. Now, what qualified distributions are distributions if the expense is for higher education, training programs, small business loans, or first-time home purchases. If the child reaches age 25, up to 100% of the fund may be withdrawn for qualified distributions. And at age 30, the whole fund is given to the beneficiary for any distribution. Now, you might think to yourself, what's the benefit of this? There's no deduction. It's an after-tax dollar contribution. What's the point of all of this besides just a savings account tied to the stock market? Now, the benefit is the qualified distributions are subject to long-term capital gains rates on the growth. Obviously, the principal is an after-tax dollar that's already been taxed, but the growth will be taxed. So it's not like a Roth account. Now, you might be thinking 15%, 20%, that might be, fine. It's lower maybe than my tax bracket, but is that really that enticing? And I would argue yes, with proper tax planning. Now, the 2025 long-term capital gains rates for married filing jointly, there's a 0% tax bracket. And that 0% tax bracket applies to all income if your taxable income is less than $96,700 for this year. If you're single, the 0% bracket is up to $48,350. Now, maybe some planning will come in where we can put the child on their own tax return so that their income is low enough so that they can take this the 0% bracket so that, most of the growth is not going to be taxed. Now, that doesn't mean once you hit the 15% bracket that the whole growth is going to be taxed at 15%. That's not true. First, the first bracket, the 0% bracket, has to be filled up if you're married filing jointly. That's the first $96,700 will be taxed at 0%. But the the income afterwards, up to 600,000 for the married filing jointly, will be taxed at 15%. Now, this doesn't mean the state will recognize that 0% bracket. It depends on your state. I've seen some states they tax capital gain income the same as ordinary income. So it will depend on what state you're living in on the state tax side, but for the federal tax side, with proper planning, you can definitely make the most of this account, and it definitely sounds like a great idea. Now, for the pilot program for people born between January 1st, 2024 and December 31st, 2028, you still get the same provisions as we just talked about. And in addition, the federal government will contribute $1,000 per child one time. And that's for every child born between January 1st, 2024 and December 31st, 2028. Now, these are going to be opened, these accounts are going to be opened by the parents or the guardians. And if the Treasury determines that the child does not have an account opened by the child's first tax return, then the Treasury will establish an account on the child's behalf. For some reason, if the parent does not want to participate in this for the child, they can definitely opt out of that. But by the first tax return of the child, if they don't have one open, they will open one for them. So the chances are low on missing out on this benefit, but it's a free $1,000. It's probably going to get taxed without proper planning, but I would take anything I can get from the government, right? Health savings accounts. There's a lot of benefits coming with this bill. Now, eligible contributions will apply for bronze and catastrophic plans. Seniors who are eligible for Medicare Part A may continue contributing to an HSA as well. The current law makes those individuals who are entitled to Part A ineligible, even if they're still enrolled in the private high deductible health plan. But with this bill, they will be able to make HSA contributions. The contribution amount will be doubled under certain income thresholds, and that's individually $75,000, and for families $150,000 or less. They can double the contribution amount, and that's of course pre-tax. Now, on-site employees who utilize discounted healthcare services at a health clinic at their work site, they can contribute to an HSA. The current law does not allow that because the IRS actually views such services as a significant medical benefit, therefore is incompatible with the HSA. But this bill removes that provision and allows these on-site employees to contribute to an HSA. Now, the catch-up contributions will be expanded for both spouses to make the catch-up contribution into one account, and that's for people aged 55 or older. Now, the current law does not allow transfers from flexible spending arrangements or health reimbursement arrangements into an HSA, but what this bill does is it will allow you to convert some of those funds in those accounts into the HSA, but that conversion is capped at $3,300 a year. So you can still get that money out of the FSA and put it into the HSA, but you can only do that, over a period of time. You can't just put the whole fund in if it's more than $3,300. And lastly, the Big Beautiful Bill allows HSA distributions for physical fitness memberships and instructional physical activity. There's two limits here. The first limit is for an individual, it's $500 per year to take money from your HSA and use it towards gym and trainer expenses. And for your family, it's $1,000 per year. Now, the second limit is it's up to 1/12 of such expenses allowed per month. What does that mean? So in my hometown, I live in Detroit. There is a Detroit Athletic Club that's one of the most famous gyms in Detroit. The fee is $1,000 a month, I think. Now, I would never pay $1,000 a month, but for a gym, but if I did, and I decided to go there, now I will pay $1,000 per month, but as a single individual, I'll be limited at the $500 a year. Now, if I was married, and let's say my gym expenses were $1,200 per month, then I would still be limited by the $1,000 family limit. And even if my gym is lower than the limits, I would be limited by 1 month of the gym and trainer expenses. So if I'm paying, which right now I'm paying $50 for my gym per month, I'd be limited by the $50 a month. So it's something, it's not a lot, but it's an opportunity for you to use your HSA. And it promotes, the health, the going to the gym and things like that. Now, the SALT cap limitation. Pros and cons here, definitely. The SALT cap contains the state and local income tax, property tax, personal property tax, sales tax. It's been $10,000 since the TCJA took effect. If this bill does not get passed, then there is no cap. You can deduct as much state and local tax as you have with no cap at all. What this provision does is it increases the $10,000 cap to $40,000 for income under 500,000. If you make over that, you get phased out. It's not a light switch, as I mentioned before. Once you start making a certain amount, the $40,000 gets less and less until you hit the $10,000, and the $10,000 is the floor for everyone. Now, originally, when this bill was introduced into the House, it was actually $30,000 and it was for income under $400,000. But there's a lot of GOP representatives that are in these so-called blue states, such as New York, California. They said, you know what, we really need to increase this. So they actually made only one amendment to the Big Beautiful Bill in the House. And one of the provisions was to increase the SALT from $30,000 deduction to $40,000 deduction. As I said, the floor is 10,000 for those making over 500,000. But when one hand gives, one hand takes away. So we all had this great pass-through entity tax workaround where in the last few years, we've been able to get around this $10,000 cap by using what we call PTE tax. And this was really enacted by the states where mostly the so-called blue states where they did not like this $10,000 cap and they just wanted to deduct their taxes. So the states legalized this rule. And what the big beautiful bill does is it limits the PTE tax to the SALT provisions. The $40,000 limit if you're within the income range, and of course, depending on your income, it can be lowered. Now, they also introduced penalties for avoidance of the SALT cap. The PTE tax was never something that the federal government wanted you to take. It was enacted by the states, against the SALT cap. But what this does, this has been happening with the partnerships with the S corporations. Now, what this is going to do is this is going to separately state the tax on the K1 that's coming into your individual to say, okay, here's how much PTE tax I have. It will be taken to the itemized deductions, right where the SALT is. And then essentially it's going to be whatever your individual amount is. Now, the IRS also will have authority to prevent any kind of avoidance. So I would kiss this provision goodbye. This is the last year that it will be taken to effect. It was great for many people, but unfortunately, this is what happens when one hand gives, one hand takes. Finally, depreciation. Bonus depreciation is back under current law. 2025 is set to 40%. 2026 is set to 20% bonus depreciation. 2027 phases down to 0%. What this bill does is it gives us 100% expense for bonus depreciation, and the asset must be placed in service between January 20th, 2025 through December 31st, 2029. Now, it's January 20th because that's the inauguration date. That was done on purpose. So you'd have to make sure that your asset, for example, your rental property, must be placed in service after January 19th, 2025. Otherwise, you'll get the 40% deduction. And this can be a big mistake that whoever your tax pro is, if they accidentally set it to January 1st, that's going to be a problem for you. Now, this hasn't been changed with the amendments yet, but I would definitely watch out for that this year in 2025. But we get our 100% bonus depreciation back. For now, we get it for 4 years, and we'll talk about some potential changes later. Also, what we have for 179 depreciation, which is an alternative method to accelerate depreciation. Currently, we have it at $1.25 million expense deduction. This is going to be doubled, and it's going to be permanent. And instead of a limit of $3 million in assets, you can have up to $4 million in assets and take advantage of the full $2.5 million expense. As I said, this is going to be permanent. And the 179 provisions applies to property placed in service after December 31st, 2024. So both of these provisions are going to be available in 2025. Again, watch out for the dates in service for the bonus depreciation. You do not want to mess that up. Now, there are some unique tax strategies here. So qualified opportunity zones, they've been around actually, but what this big, beautiful bill is going to do is introduce a second round of opportunity zones with a bonus for a certain type of property. So if you don't know what opportunity zones are economic development tools to revitalize distressed communities across the country. Investing in low-income communities are incentivized for certain tax benefits in a 10-year window. Now, what this does is it allows you to invest your unrealized gains into an opportunity zone. So if you've had tons of growth in whatever vehicle you're investing in, you can move this over to the opportunity zone. And what this does is it allows you to invest in some sort of poverty level. There are percentages on what the poverty level is in the code, but just for a general, idea of what this program is, it allows you to shift your money into this opportunity zone, and it must be done in a qualified account, a qualified opportunity zone account. It can't just be any bank account. You have to have proper reporting as well. So the regulations are pretty strict on what you can do and what you can not do. But the benefits is you can invest your unrealized gains into opportunity zones, and there can be an exclusion of capital gains tax. Now, if you hold your investment for 5 years in a regular opportunity zone, what that does is brings your basis of whatever you had invested increased by 10%. And that lowers your gain if you decide to pull out the opportunity zone investment after 5 years. After 7 years, you get an additional 5% for a total 15% step up in basis. Now, after 10 years, you get a permanent exclusion of tax on the funds that you invested into the opportunity fund. So this is going to be great if you have a huge unrealized gain that you're sitting on and you can wait 10 years. It's more of a thing on the side for you. This would be a great idea. Now, opportunity zones have been extended to include rural areas which supports the farmers. This is one of the campaign promises from the current administration. So the rural benefits are actually greater than the regular opportunity zones. So if you're reading right here, for 5 years instead of the 10%, for rules, it's going to be 30% step up in basis. For 7 years, you'll get the plus five. And then in 10 years, you'll get a permanent exclusion of taxable income on the gains resulting from the original investment. Now, for qualified production property, which this is a new provision, it allows 100% of bonus depreciation of entire new factories and improvements. This is in reaction to all of the tariffs that's been going on. The incentive is for companies to move their factories from outside the country or even start new factories into this country. And what they can do is they can bonus the entire building. What we know as real estate investors is when we have a building, we have to do a cost segregation. We have to bonus depreciate everything 20 years or less with an asset class life, and everything else, like the 27.5 year asset life or the 39-year asset life for short-term rentals, we have to stretch that out. We cannot bonus that. What these factories are now allowed to do is bonus the whole building. The, there's no cost segregation necessary. There's strict rules for sure. Now, what happens with these, they can have new factories, certain improvements to existing factories, and certain other structures in the year the property is placed in service. Now, the property must be used for manufacturing, production, or refining of agricultural or chemical production. The property must begin after 2024 and must be finished before 2030. The property must be placed in service by 2034, and the ineligible people that cannot take this, are properties used for offices, administrative services, lodging, parking, sales activities, research activities, and software engineering activities. So if you have any ideas on, I can produce this, you guys are doctors, maybe you can produce something. This is now the time to do it. You have, you know, 4 years and some change to, get started with your investments. You can depreciate the whole thing. This is the time to do it. With research and development expensing, the big beautiful bill allows taxpayers to immediately deduct these R&D expenses. Typically, what the current law says is it will allow you to deduct over a 5 year period if the research or experiments are domestic, and if it's foreign, 15 years. Now, what this provision does is it allows you to do immediate expensing like we've seen before, and it must be domestic for the immediate expenses. Now, it does not apply for purchasing property. These are for you cannot use them for location or extent or of minerals such as oil and gas. So that it's really for the research and it's really for experimentation, and it doesn't count with the land or the property that you're buying. Energy activities. So there are some tax credits phasing out by 2028. By the end of that, we'll see the wind and solar, nuclear, and electricity investment production tax credits leaving. And then by the end of this current year, we will see the energy efficient home improvements leaving, the clean energy leaving, and the clean vehicle tax credits leaving. So if you are interested in buying an electric vehicle and you still want to take the tax credit, which for some vehicles it's still $7,500, you must acquire it before January 1st, 2026. This is the last time you're going to see this credit. I'm sure you've heard on the news all of the the backlash on that, but the promotion really is to end the EV mandates and stuff like that. So this administration is not a fan of the EVs, so they're getting rid of all of these tax credits. Now, what 1099K is, this might seem, very nuanced. So if you're using apps like Venmo, Zelle, Cash App, typically what happens is, you can send money all you want, but when you receive money, these apps are supposed to be tracking how much you're receiving so that they can issue you a 1099. Now, that sounds bad, right? Currently, in the current law, what this next year is going to do is set the requirement to $600 without the big beautiful bill passing. So if you received $600 or more, regardless of how many transactions it took, then they will issue you a 1099. Now, Zelle has come out and said, we're not going to comply with this. That's why I always use Zelle. But Venmo, PayPal, Cash App, that's what apps are going to be involved in this. What the big beautiful bill will do is set that limit back to $20,000, and it has to be more than 200 transactions. That's going to be the requirement to issue you a 1099 if you've received more than $20,000. So that's going to be a big change, and that was a big problem that we were going to see. And we actually saw IRS did not enforce this rule because all of the apps did not want to comply with it. So they pushed it and kicked the can down the road. What this bill will do is set that limit very high so that these apps don't have to do a lot of compliance work. And also we will see a lot of, there could have been potential audits for sure, because if you're receiving a 1099, you're not reporting it, or you're reporting it, maybe you're paying extra tax on it and you don't know how to deal with it. That was going to be a big problem without this provision. So I'm glad it's here. Some takeaways just to go through everything again. We saw our depreciation. We talked about the salt limits. We talked about some, planning strategies with the mega Trump accounts and the opportunity zones. We saw some HSA benefits, but also some negatives. We saw, the ending of the pass-through entity workaround after this year. We're going to see a permanent excess business loss limitation, and the energy credits leaving us as well. So the current status of this bill, on May 22nd, as I said, the House of Representatives passed this bill with one amendment, and the vote actually came down by one. Um, there were all 215 votes were Republicans, all 214 votes were Democrats. There were two no votes, which were Republicans from New York and Arizona, and one person voting present, which is a Republican from Maryland. And currently, right now, the bill is sitting in the Senate. It's currently being debated. And Senate Majority Leader John Thune still promises a timetable for a compromise bill to meet President Trump's desk on July 4th. So they're still promising that, and they're still saying everything is going well. Um, I see this as they got over the bigger hill. There's still a big hill to come, but it's not as big as it was in the House of Representatives. The House of Representatives, there was a very slim majority. If you're looking at it from a percentage point of view, one more vote and this wouldn't have made it to the Senate. The Senate has 53 Republicans, and everyone else is either a Democrat or an independent. So there's still a couple votes, for leeway, just like the House, but it's less control. You have to control 215 people in the House versus 50 people, because all you really need is a tie, because then the vice president will come in and cast a tie-breaking vote, as we saw in the Inflation Reduction Act a couple of years ago, which is what Vice President Harris did, funding the IRS and things like that. Now, some concerns and some rumors with the bill, if you haven't been following the politics around it. The main concern is the national debt. The Congressional Budget Office projects the bill would add at least $2.4 trillion to the federal deficit over the next decade. Factoring the tax changes, the potential increase could be 3.8 trillion, around there. The GOP senators are calling this spending completely unsustainable. And right now, what we're seeing is continued fights. Now, we're seeing salt cap fights. Right now, they increased it, as I said, from 30,000 to 40,000 in the amendment in the House. But what I see, and actually what I've heard, is the Senate Majority Leader John Thune and President Trump, they're okay with bringing that 40,000 down. Really, the people who wanted that up were the GOP representatives because of they're from these blue states, as they call it, and they really want to just show their constituents that they're fighting for them and they want to increase this deduction for them, but they're okay with bringing that down. Now, another rumor that I've been hearing, it hasn't come to fruition in this First Amendment, but we may see this as part of the Senate package of the bill, where the 39.6% tax bracket comes in to sort of offset some of the worries about the tax breaks, because $3.8 trillion adding to the debt sounds like a lot, and it is a lot. So to comply and to kind of balance the budget a little bit, they might add this tax bracket for very high income earners. So it depends on what they set the threshold at, but we could see an increase in tax for those ultra wealthy people. Now, there is a big rumor, and actually, it's been stated by Senator John Thune. He's the majority leader of the GOP Senate, and he said we're working on bringing 100% bonus depreciation permanent. He's also talked about that with R&D expensing and certain interest deductibility. I don't know what's going to happen. That sounds great because right now there's no end game with the 4 years of 100% bonus depreciation. We don't know if that's going to be phased down like we saw it, if it's just going to fall off to zero and we have to see another bill come through Congress and go through all of this again. So hopefully it is permanent, at least that provision, so that we don't have to worry, okay, after 2030, what am I going to do? Do I only have 4 years to do these real estate investments if that's what you want to do? Do I have only a certain amount of years to do to write off all these business expenses? Should I buy all my real estate now? What's gonna happen? So it's tough for planning. And speaking of planning opportunities, if you watched my last webinar earlier this year, I've taken the exact same points just to show you what was rumored back then versus what we are seeing in this bill. We talked about real estate strategies. This is going to come back with 100% bonus. As I mentioned in my last webinar, both parties want 100% bonus depreciation, whether it's the GOP, whether it's the Democrats. We saw this with a bill a couple of years ago. Actually, it was last year with the child tax credit bill. It was bumped in with the 100% bonus depreciation rule. And that bill did not make it out of the House because they were not agreeing on the child tax credit levels. So both parties want the 100% bonus, and that's what we're going to see. But I'd be curious to see if they make it permanent. I hope they do, or at least they extend it longer than 4 years. Now we saw the solar and EV activities leaving. If you've been following the news, there are industry leaders, such as Elon Musk. They claim that these incentives that are being taken away are super unfair because the oil and gas incentives are still available. But that's just what the agenda is with the administration, and that's what they decided to do. And we talked about, is there a planning opportunity for no tax on tips and no tax on overtime? With tips, I don't see something at this moment the way it's currently written because the IRS is going to introduce tons of regulations and rules and guidance on what you can and mostly cannot do with the no tax on tips rules. Because as I mentioned in my last webinar, we will try every way we can to see, okay, how can we make this deductible for our business owners? So they, in the tips side, it seems that they have really regulated it so that it only applies in certain businesses. Now with overtime, there may be some planning opportunities there with your reasonable comp. That really depends on if there's extra guidance that it's going to come out with the IRS. But there may be some opportunities there. Maybe you can say, it depends on also on your income level, but maybe you can say, I worked extra, more than 40 hours and I'm gonna double time my pay. So maybe there's some planning there. Now, with some IRS defunding, just today, earlier today, former Congressman Billy Long has officially been confirmed as the new IRS commissioner. I can now say that I know and have met the sitting IRS commissioner. The IRS commissioner is focused on dialing back the previous administration's tax enforcement expansion that was aimed at increasing audits on high-income households and corporations. The main focus moving forward is customer service and technology improvements. It's been long known that the IRS has been running on ancient technology, and I'm sure your own tax professionals can tell you how painful it is to actually communicate with the IRS agents. There could be smarter IT systems with an artificial intelligence boom, coupled with an expected 37% reduction in the IRS in 2026. Another thing I can tell you about Billy Long is that he loves tax strategies. He fully supports the legal, moral, and ethical strategies taxpayers can use to minimize their taxable income. We're all excited for him to see what he'll do to make the IRS way more efficient. Now, the outcome of the big, beautiful bill may impact what you want to do. Hopefully, you're telling yourself, tax planning can save you when you're unsure how to plan ahead of these massive tax changes. As I said earlier with this new bill, tax planning is no longer a wait and see game, it's a now or never scenario. If you're thinking, what's the first step in tax planning in 2025? How can I lower my tax burden? And what do I have to do? I can tell you this. No matter if you're a private practice professional or a high income W 2, there's always potential for paying less tax. The first step in paying less tax is really like going to the doctor. If you're sick and you visit the doctor, typically three things happen. First, the doctor examines you and diagnoses the problem. Does your stomach hurt? Maybe it's food poisoning. Maybe it's something more serious like pancreatitis. Regardless, the doctors have to figure out what the problem is before they can solve it. Next, the doctor prescribes the solution. What's it going to take to fix the problem? And finally, someone has to fill that prescription. That might involve a trip to the pharmacy for medication. It might mean surgery. It might mean physical therapy. But if the problem is serious, it's not just going to fix itself. The tax planning we do for you follows that same model. The diagnosis takes the form of a tax discovery session. We're going to look over your business and personal tax returns along with any supporting documents like your profit and loss, your balance sheet. We're going to ask you a series of questions about your goals, and then we diagnose any mistakes and missed opportunities that might be costing you taxes where you don't have to pay. The prescription takes the form of a tax planning proposal that introduces you to the strategies you're missing. It could be one strategy. It could be three strategies. It could be more than that, depending on your situation. We will tell you how much we can save you in tax in the proposal. And finally, in the implementation, this is what fills the prescription. This includes the guides, checklists, forms, and referrals to specialists that you need to put the strategies to work, document them properly, and audit-proof your returns. After that, we will repeat for next year because every year is different, especially with the new big beautiful bill coming into law. Now, if you'd like us to diagnose your tax situation, you can schedule a tax discovery session through our website, taxplanningboutique.com/book. From there, you can select who you'd like to meet with between myself and Lubna. We'll do exactly what I just mentioned in the previous slide. I'm looking forward to a year full of tax savings, and I hope you can join us. Thanks for having us, Jordan. Thanks for the audience for joining us, and I'm happy to take any questions and open any discussions.
Yeah, thanks so much, Paul. That was, as always, extremely thorough and definitely a lot that I learned from it. A couple questions we have here, and then definitely everyone feel free to keep throwing any questions in the chat, or you can even just unmute yourself and ask. Um, Amanda's asking, and I think this is in relation to the income limit for phasing out the increased salt tax deductions. Is the 500,000, yes, perfect. Is the 500,000, is that married filing jointly or individual?
Um, as of right now, it's married filing jointly, but that could change. I would say it's best to wait until the Senate approves their version of the bill to really see what the income thresholds are going to be. You can plan on it being married filing jointly because they haven't, came out and said anything specific. Typically, when it passes the House, when this bill passed the House, that's when we say, okay, this is for real. It's in the Senate. let's review everything. Now we have to see what the Senate does. They could make it as part of a negotiation. 40,000, or yeah, the income level is 500,000 for married filing jointly. Maybe they cut it in half for singles, or maybe they cut it in half for just married filing separately. Because most thresholds, it's either married filing jointly and everyone else except for married filing separately. And for other provisions, the thresholds are, all right, here it is for married filing jointly only, and everyone else gets half of that. So it really depends on what they come out with.
And then Mark has a great question too, which is one that I was considering. So in terms of like the overtime, no tax on overtime potential, can you, and you sort of talked a little bit about this, but could that apply to physicians in different scenarios? And the one that Mark's bring up is like excess call or kind of like being on call beyond your normal working hours or something like that. Could that be considered overtime? Or are there any other sort of potential, maybe manipulations isn't the right word, but ways of using that for physicians?
Well, it might not be used for physicians because typically the income is pretty high, but pairing this with hiring your kids in a business might be great. Maybe if they're working, more hours and they actually work for you and they make less than 160,000, and maybe you say in your contract, we'll do a double time after 40 hours, or I don't know if they will allow you to do triple time after hours, so that maybe your kids can take that advantage of that instead of maybe you if you're making too much money. So it is a little bit early, and these are just ideas, but we have to see what the Senate comes out with, of course, and then also we have to see what the IRS comes out with for some guidance, because of course there's always going to be room to see, okay, they did not address this portion, looks like it's up for play.
Mhm.
Like with tips, maybe they will say, all right, here's what you cannot do. Actually, one of the regulations in the bill for the no tax on tips is if you customarily already receive tips in 20, like before 2024 and 2025, then yeah, it's normal to take this provision. But if you've never taken a tip before 2025, then it's not doesn't look like it's customary in your business because you just changed your whole business model to take no tax on tips. So it really depends on, what the guidance comes out to, but it's just an idea. It's nothing to write home about and, call up your tax pro and say, we got to change all of our contracts and I got to hire all of my, everything like that. So I would take it with a grain of salt, but they're just planning ideas and we have to see what comes out at the other end.
Awesome. Um, well, we've reached our time, and so I want to be considerate of everyone's time, including you, Paul and Lubna. I thank you so much again. This was incredibly educational. I'll definitely be distilling it down into a post, and we'll have the replay video to send to everyone as well, so you can review because there's just a ton of usable information there. As Paul said, if you're looking to get in touch with them or ask questions, taxplanningboutique.com/book. Thank you all for joining. Thank you again, Paul Lubna, for sharing all of this amazing information.
It's my pleasure. Thank you guys for joining us. And of course, if you have any questions, please feel free to reach out.
Thank you, Jordan.
Awesome. Thank you all. Have a good
Have a
night.
good day. You too.
Have a great night.